Okay, so you want to own an insurance company, not a restaurant, not a hotel, not a factory, an insurance company. You imagine a simple business. People send you money every month. Most of them never file a claim. You invest the cash while you wait. And when something eventually goes wrong, you write a check that's much smaller than everything you've collected. From the outside, it almost sounds like legalized money printing. In fact, some of the richest investors in history, including Warren Buffett, built enormous fortunes around insurance, using the industry's unique cash flows to fund investments across dozens of other businesses. So why doesn't every billionaire start an insurance company? Because the business isn't really about selling insurance. It's about selling confidence. You're promising people that if the worst day of their lives ever arrives, you'll still be standing. That's a promise that might not have to be kept today or tomorrow, but maybe 10 years from now. And the moment customers believe you can't keep that promise, your business starts falling apart long before you actually run out of money. That's why an insurance company doesn't behave like a normal business. A coffee shop sells coffee. A car dealership sells cars. A software company sells subscriptions. An insurer sells something invisible, a promise. And promises are surprisingly expensive to manufacture. Every year, Americans pay well over $1 trillion in insurance premiums across property, casualty, life, and health insurance combined, making insurance one of the largest financial industries in the country. That number is almost impossible to picture. It's larger than the economy of many countries. Yet most people only think about insurance for about 5 minutes a month, right before paying the bill, which makes this one of the least understood industries in the entire economy. Here's something that surprises almost everyone. Insurance companies actually hope something bad happens. Not something catastrophic, but enough claims to prove their product works. Because a company that never pays claims doesn't build trust, and trust is the only product they're really selling. Imagine two companies. The first denies every claim. The second pays legitimate claims quickly. Which company would you insure your home with? Exactly. Claims are an expense, but they're also marketing. Sometimes the biggest advertisement an insurer can ever buy is the check it writes after a hurricane destroys an entire neighborhood. That seems backwards until you realize what insurance really is. It isn't protection from disasters. It's protection from financial uncertainty. People aren't buying the replacement roof, they're buying peace of mind. And people pay extraordinary amounts for certainty. Think about your own life. You lock your front door every night, not because someone tries to break in every evening, because the possibility exists. Insurance works exactly the same way. You're paying to remove uncertainty from your future. Psychologists have known for decades that humans experience the pain of losing something much more intensely than the pleasure of gaining something of equal value. Lose a $10,000 car, and it hurts far more than finding $10,000 feels good. Insurance companies have quietly built one of the world's largest industries around that single psychological principle. But here's where things become interesting. Most people believe insurance companies make money because customers pay premiums and don't file claims. Sometimes that's true. Often, it's not. Let's imagine you decide to open your own insurance company. You rent an office, hire a few experienced underwriters, bring in lawyers, customer service agents, claims adjusters, accountants, technology specialists, compliance officers, actuaries. Before you've sold a single policy, you've already discovered something unexpected. Insurance is one of the most heavily regulated businesses in America. You don't simply announce you're selling policies next Monday. Every state has its own insurance regulator, capital requirements, licensing rules, reserve requirements, consumer protection laws, financial reporting standards. Your company needs approval before it can even begin selling promises. Why? Because unlike most businesses, your customers pay first, but expect you to deliver years later. Imagine collecting money today for a claim that won't arrive until 2042. How does anyone know you'll still exist? Regulators answer that question. They force insurers to maintain enormous financial cushions, money that cannot simply be spent, money sitting there, waiting just in case. This surprises many first-time entrepreneurs. The biggest challenge isn't finding customers, it's convincing regulators you can afford to keep your promises. And that requires capital, lots of it. Depending on the type of insurance, launching a licensed insurer can require tens of millions of dollars before meaningful operations even begin. Not because you're buying expensive machinery, because you're buying credibility. Here's another misconception. People think insurance companies immediately own every premium they collect. They don't. A large portion has to be reserved for future claims. Imagine someone pays your company $2,000 to insure your house for the next year. That doesn't mean you just made $2,000. Some of that money belongs to future disasters. You simply don't know whose disaster yet. This creates one of the strangest balance sheets in business. The money sits in your bank account, but economically, much of it already belongs to someone else. loss. The industry even has a name for these obligations: loss reserves. They're estimates of claims that haven't happened yet, or have happened but haven't been fully paid. Think about a major hurricane, thousands of damaged homes. Claims continue arriving for months. Repairs stretch into years. Court cases take even longer. Some claims open today won't fully close until the next decade. Your accounting system has to estimate those future payments long before anyone knows the final number. And those estimates determine whether your company looks wildly profitable or dangerously weak. That's why insurers employ actuaries. If engineers build bridges, actuaries build financial survival. Their job sounds simple: predict the future. In reality, they're using mathematics, probability, demographics, weather history, medical research, driving behavior, crime statistics, inflation forecasts, and decades of historical data to answer one question: how likely is this customer to cost us money? That calculation decides almost everything: your premium, your deductible, whether you're approved, even whether the company wants you as a customer at all. People often assume insurance pricing is personal. It isn't. It's statistical. Suppose your company insures 100,000 identical homes. History might suggest around 900 claims this year. Not exactly 900, maybe 850, maybe 970, but close enough. The larger the customer pool becomes, the more predictable the business actually gets. That's one reason companies fight so hard to become bigger. Size doesn't just increase revenue, it reduces uncertainty. A company insuring 100 homes is gambling. A company insuring 10 million homes is doing mathematics, which explains why the largest American insurers have become so dominant. Companies like State Farm, Progressive, Geico, Allstate, Travelers, and Chubb don't just have more customers, they have better data. And better data produces better pricing. Better pricing attracts healthier customers. Healthier customers produce stronger profits. The cycle feeds itself. But then something happens that completely changes how you should think about this business. Imagine your company collects $1 billion in premiums this year. Most people assume the company immediately starts earning profits. Not exactly, because most claims won't be paid today. Some won't be paid for months, others years. That creates something investors obsess over: the float. If you've never heard that word before, it's one of the most important concepts in finance, and it's the reason some of history's greatest investors became fascinated with insurance. Because unlike a bank, which borrows money and pays interest, an insurance company often gets paid first for holding someone else's money. That sounds almost impossible, yet that's exactly how the business works. The customer pays today, the claim comes later. Everything sitting in between becomes one of the most powerful financial tools ever created. Warren Buffett once described insurance float as money that doesn't belong to you, but that you get to control for a period of time. That single idea transformed not only one company, but an entire investing philosophy. Imagine your insurance company collects $10 billion in premiums this year. You won't write $10 billion worth of claim checks tomorrow morning. Some claims arrive next week, others next month. Some lawsuits won't settle for years. Certain life insurance policies might not pay out for decades. Until then, that money is sitting on your balance sheet. It isn't profit, it isn't free cash, but it can be invested. That's why insurance companies don't keep billions of dollars sitting in checking accounts. They build enormous investment portfolios: government bonds, corporate bonds, municipal debt, commercial real estate, stocks, infrastructure, private credit. Every dollar has a job. And suddenly, you realize something unexpected. The insurance company isn't just selling insurance anymore. It's managing one of the largest investment funds in the world. This is where many first-time entrepreneurs completely misunderstand the business. They think underwriting is the product. It isn't. Underwriting creates the float. The float creates the investment opportunity. The investment portfolio is often where extraordinary wealth is built. But here's the catch. You can't simply chase the highest investment returns. Remember the promise you made? Someone's house could burn down tomorrow. A hurricane could make landfall this weekend. A tornado could tear through an entire town tonight. That means your money has to remain available. An insurer earning 15% a year on risky investments doesn't matter much if it can't pay claims when customers need it most. Liquidity becomes just as important as profitability. This balancing act defines the entire industry. Earn too little on investments, and shareholders become frustrated. Reach too far for higher returns, and regulators start asking uncomfortable questions. Some of the best-run insurers spend decades finding that balance. Now imagine another scenario. Your company insures 1 million drivers across the country. Everything looks predictable. Then one winter, an unexpected ice storm shuts down highways across multiple states. Within hours, thousands of accidents happen almost simultaneously. Claims departments become overwhelmed, Tow trucks are booked solid. Body shops develop waiting lists stretching for months. Replacement parts become scarce. Labor costs rise. What looked like thousands of small accidents suddenly becomes a financial event worth hundreds of millions of dollars. The risk wasn't just the crashes, it was the concentration. Insurance companies don't fear individual claims nearly as much as they fear many claims happening at once. That's why diversification matters so much. The ideal insurance portfolio doesn't insure everyone living on the same coastline, or everyone driving the same type of vehicle, or everyone working in the same industry. It spreads risk across geography, across demographics, across property types, across economic conditions, because disasters rarely ask permission before they arrive. Then comes the question almost every customer asks at some point. If insurance companies have so much money, why do they sometimes deny claims? The answer is more complicated than most headlines suggest. Some claims are denied because they fall outside the policy's coverage. Others because information wasn't disclosed accurately. Some involve fraud, and insurance fraud is a much bigger business than most people realize. Every year, fraudulent insurance claims cost the U.S. industry tens of billions of dollars. Some are surprisingly small: a fake stolen phone, a staged fender bender, an exaggerated medical bill. Others involve organized criminal networks staging accidents involving multiple vehicles and fake injuries. From the outside, it might seem like a victimless crime, but every fraudulent dollar eventually gets paid by honest customers through higher premiums. That's why insurers invest heavily in fraud detection, artificial intelligence, data analytics, behavioral modeling, license plate databases, satellite imagery, even social media investigations in certain cases. Today, many suspicious claims are reviewed by algorithms long before a human investigator ever opens the file. Technology has quietly become one of the industry's biggest competitive advantages. The companies collecting the best data usually make the best decisions, which brings us to another hidden layer almost nobody talks about: reinsurance. Think of it as insurance for insurance companies. Imagine your company insures thousands of luxury homes along the Florida coastline. Everything looks profitable for years. Then one Category 5 hurricane arrives. Without protection, one storm could bankrupt your entire business. So you pay another company, a reinsurer, to absorb part of that risk. In exchange for a portion of your premium income, they agree to step in once losses exceed certain levels. It sounds strange at first. Why would an insurance company willingly give away revenue? Because survival matters more than maximizing this year's profits. Some of the world's largest financial institutions specialize almost entirely in reinsurance. Their entire business model revolves around helping primary insurers survive disasters that are simply too large for one company to absorb alone. This creates an invisible financial safety net stretching across the entire global economy. When hurricanes strike Florida, earthquakes hit California, wildfires spread across the West, or typhoons damage property in Asia, money often flows through multiple insurance companies and multiple reinsurers before the final claim is ever paid. Most customers never notice. They simply receive their settlement. Behind the scenes, billions of dollars may have crossed international financial markets to make that possible. That's the remarkable part. Insurance feels local, but financially, it's one of the most globally connected businesses on earth. And then there's a force no insurance executive can control: inflation. Imagine pricing a homeowner's policy today based on rebuilding a house for $400,000. 2 years later, construction materials double in price. Labor becomes scarce. Supply chains slow down. Now rebuilding that same house costs $550,000. Your premium was calculated using yesterday's prices. Your claims arrive today's prices. That gap can erase profits astonishingly fast. The same thing happens with automobiles. A bumper that once cost $900 suddenly costs $1,700. Repair shops raise labor rates. Advanced driver assistance systems require expensive recalibration after even minor accidents. Modern vehicles aren't just harder to repair, they're more expensive to repair correctly. One small parking lot collision can generate a repair bill that would have totaled an older vehicle, which explains something customers often find frustrating. Premiums don't always rise because you're a riskier driver. Sometimes they rise because repairing every vehicle has become dramatically more expensive. The insurance company isn't necessarily earning more. It's trying to keep pace with rising costs. And if it guesses wrong, even by a small margin, the consequences can last for years. One mistake today might still be affecting profitability 5 years from now. That's why the industry changes prices carefully. Too aggressive, customers leave. Too conservative, the company loses money. Finding the balance is less about selling policies and more about predicting the future better than competitors can. That sounds almost impossible, because nobody knows exactly when the next hurricane will make landfall. Nobody knows which neighborhood will experience a spike in theft. Nobody knows when a once-in-a-century wildfire will become the second once-in-a-century wildfire in just
just 5 years. And yet, insurance companies have to put a price on those unknowns every single day. Get that price wrong, and the consequences don't always show up immediately. Sometimes they take years. Let's imagine your company decides to lower premiums by 20%. Customers love it. New policies flood in. Sales teams celebrate. Revenue jumps almost overnight. From the outside, it looks like brilliant management. But here's the problem. You won't know whether those prices were actually profitable until years later, after thousands of claims have worked their way through the system. Insurance is one of the few businesses where you often discover whether you made money long after you made the sale. That's why executives don't celebrate premium growth by itself. They celebrate something called the combined ratio. If you've never heard that term before, don't worry. It's surprisingly simple. Imagine your company collects $100 in premiums. Now add up every dollar spent paying claims and every dollar spent running the business. If those expenses total $95, your combined ratio is 95. That means your insurance operations earned $5 before investment income. But if your expenses reach $105, your combined ratio becomes 105. Now your insurance business is actually losing money. At first glance, that sounds like failure. Except sometimes it isn't. Remember the float? Some insurers are perfectly willing to lose a small amount on underwriting if they believe the investment returns on billions of dollars of float will more than make up the difference. Others refuse to write business unless underwriting itself remains profitable. Different philosophies, same industry. And that difference explains why investors pay so much attention to companies with disciplined underwriting cultures. It's one reason Berkshire Hathaway has spent decades emphasizing that underwriting profit comes first, while the float becomes an additional advantage rather than an excuse for careless pricing. Now let's talk about competition. From the outside, insurance feels crowded. Commercials appear during nearly every football game. Talking lizards, funny spokespeople, catchy jingles. It almost looks like every company sells the exact same product. But behind those advertisements, the strategies couldn't be more different. State Farm dominates because of its enormous agent network and broad customer base. Progressive became famous for pricing innovation and sophisticated risk models. GEI built its reputation around direct-to-consumer sales, eliminating many traditional agency costs. Chubb focuses heavily on affluent customers and commercial clients. Meanwhile, Travelers has become one of the country's largest commercial insurers. Each company is technically selling insurance, but they're really competing on completely different strengths. The latest industry rankings still place State Farm at the top of U.S. property and casualty insurance, followed by Progressive, Berkshire Hathaway's insurance operations, Allstate, Liberty Mutual, Travelers, USSAA, and Chubb. Notice something interesting. Almost none of these companies became leaders by simply offering the cheapest price, because the cheapest customer isn't always the best customer. Suppose two drivers apply for identical policies. One has never filed a claim in 20 years. The other files a claim almost every year. Charging both customers exactly the same premium sounds fair. Financially, it would be disastrous. The healthiest insurance companies aren't trying to insure everyone. They're trying to insure the right people at the right price. That requires an unbelievable amount of information. Driving records, credit-based insurance scores were permitted, repair histories, weather patterns, building materials, crime statistics. Even the distance between a home and the nearest fire station can influence premiums. Every additional data point helps reduce uncertainty, and uncertainty is expensive. But here's where the economics become even more fascinating. Insurance companies aren't just competing against each other anymore. They're competing against technology. Artificial intelligence is changing almost every stage of the business. Instead of waiting days for a claims adjuster to inspect roof damage, some companies now use satellite imagery, drones, and AI-powered image analysis to estimate losses within hours. Instead of manually reviewing thousands of applications, algorithms flag unusual risks almost instantly. Instead of detecting fraud months later, machine learning models identify suspicious claim patterns before payment are even approved. Technology doesn't eliminate risk. It simply helps companies understand it faster. And speed matters, because the faster an insurer understands what's happening, the faster it can adjust prices. That pricing power becomes especially important after major disasters. Think back to Hurricane Katrina, or Hurricane Ian, or the devastating California wildfire seasons. Each event generated tens of billions of dollars in insured losses. Entire neighborhoods disappeared. Thousands of claims arrived almost simultaneously. Suddenly, the industry's carefully built mathematical models were facing reality. Some companies absorbed the losses remarkably well. Others struggled, not because they lacked customers, but because they had concentrated too much exposure in exactly the wrong places. It's one of the oldest lessons in insurance. Growth without diversification eventually becomes becomes risk, and risk, if misunderstood, becomes bankruptcy. History is full of companies that expanded rapidly during good years, only to discover one catastrophic event could erase decades of profits. The policy is simply the paperwork. The real product has always been confidence. If you enjoyed pulling back the curtain on how one of America's biggest industries really works, subscribe for more deep dives into the economics behind businesses that look simple on the surface but operate in ways most people never see.